Have you ever wondered why your paycheck never seems to stretch as far as it should? Why working harder doesn't necessarily mean getting ahead financially? The answer isn't your spending habits or lack of discipline. It's a system that was deliberately engineered centuries ago to ensure wealth flows in one direction, upward, while keeping everyone else trapped in a cycle they can't escape. Right now, as you're watching this video, every single person on Earth is participating in the largest wealth transfer mechanism in human history. It's happening automatically, invisibly, and most people have no idea it exists. This isn't about taxes or inflation, though those are symptoms. This is about something much deeper, much more fundamental to how money itself works. What I'm about to show you will change everything you thought you knew about debt, money, and why financial freedom feels impossible for most people. Because the truth is, the global financial system wasn't designed to help you build wealth. It was designed to extract it from you, permanently and systematically. Today, we're going to expose the exact mechanisms that keep this wealth extraction machine running smoothly. You'll discover how a handful of brilliant minds across different centuries created interlocking systems that make escape nearly impossible. And by the end of this series, you'll understand why personal financial advice, while helpful, can only take you so far when the entire game is rigged from the start. Let's start with a simple question that should make you uncomfortable. If every major economy on the planet is drowning in debt, who exactly is getting rich from all that borrowed money? The United States government owes over $38 trillion. Japan carries $9 trillion in debt. When you add up all the debt from every country, every corporation, and every household on Earth, the total exceeds $300 trillion. That's 3 times larger than the entire global economy. Think about that for a moment. The world owes more money than the world produces. But debt isn't money that disappears into thin air. Every dollar borrowed by someone is a dollar earned by someone else. Every interest payment made by a debtor becomes income for a creditor. So when governments pay hundreds of billions in interest each year, where does that money go? The answer reveals the first layer of this massive wealth extraction system. Those interest payments flow to institutions that hold government bonds, pension funds, insurance companies, investment banks, and asset management firms. These institutions use other people's money to buy government debt, then collect the interest payments, your retirement savings, your insurance premiums, your tax dollars, all working together to generate returns for financial institutions, while governments promise to pay interest forever. But here's where it gets truly insidious. This system didn't evolve naturally. It was intentionally designed by specific individuals who understood exactly what they were creating. They built a machine that transforms your labor into their wealth, and they made it so essential to the functioning of modern economies that dismantling it would cause complete collapse. The blueprint for this system emerged in late 17th century England, during a time when the old ways of borrowing money were breaking down. Before then, when kings needed money, they would approach wealthy merchants or nobles, promise to pay back the loan with interest, and either honor their commitment or default entirely. If they defaulted, creditors lost their money, kings found new lenders, and the system reset. It was risky for lenders and embarrassing for rulers, but it was contained and temporary. A Scottish merchant and financial innovator named William Paterson changed everything with a revolutionary idea. Instead of temporary loans that governments would eventually repay, he proposed permanent debt that would generate interest payments forever. The concept was elegant in its simplicity and devastating in its implications. Governments would borrow money, pay interest annually, but never repay the principal amount. Paterson's timing was perfect. England was locked in expensive wars with France. The royal treasury was empty, and traditional lenders were refusing new loans because the crown had defaulted before. He approached King William III with a proposal that seemed to solve everyone's problems. A group of wealthy merchants would lend the government £1.2 million, equivalent to about $300 million today. In exchange, the government would pay 8% interest annually, forever. To manage this arrangement, Paterson proposed creating an entirely new type of institution, the Bank of England. The mechanics were ingenious and revolutionary. Merchant lenders would deposit their gold with this new bank. The bank would lend that gold to the government. The government would pay annual interest from tax revenue, and the bank would distribute those interest payments to the original lenders. But the crucial innovation was that the government would never repay the principal. The loan was designed to be permanent. Why would merchants accept this arrangement? Because the interest payments were guaranteed by Parliament and backed by the government's power to tax its citizens. As long as England could collect taxes, the interest would flow. The banknotes that lenders received in exchange for their gold could be traded and were actually better than gold because they generated ongoing returns. When Parliament approved Paterson's scheme in 1694, they unknowingly created the template for modern government finance. For the first time in history, national debt became a permanent feature rather than a temporary problem. The government received immediate funding for its wars, the merchants secured a guaranteed income stream, and the Bank of England was born. Here's what made this system brilliant for the lenders and catastrophic for everyone else. The government paid £96,000 in interest every year on that original loan. The merchants had essentially purchased an annuity from the government. As long as England existed and could tax its citizens, money would flow to them annually. If they wanted liquidity, they could sell their banknotes to other investors, but the debt itself would never disappear. Paterson's real stroke of genius came next. The Bank of England received the authority to issue paper money backed by the government's debt. They could print currency up to the value of the government loans. This created money directly from debt. The government's promise to pay became actual currency. The more the government borrowed, the more money could be created. This established the fundamental template that still governs global finance today. Governments borrow money they never intend to fully repay. They pay interest forever funded by taxation, and the debt itself becomes the basis for money creation. It's a brilliant system if you're collecting the interest payments. It's a trap if you're the one paying taxes to fund those payments. Within 50 years, every major European power had copied this model. France created similar permanent debt instruments. The Netherlands formalized their government debt issuance. And when the United States gained independence, Alexander Hamilton explicitly modeled the American financial system on the Bank of England. Permanent debt, interest paid from taxes, bonds traded as currency. Paterson died in 1719 without accumulating great personal wealth, despite creating one of the most important financial institutions in history. But the system he designed has persisted for over 3 centuries. The Bank of England still exists. British government debt has never been fully paid off. It's been refinanced, expanded, and restructured countless times, but never eliminated. The debt trap was set in 1694, and every government since has walked into it willingly. But Paterson's innovation was only the beginning. The system he created would be expanded, industrialized, and globalized by other financial architects who understood its potential for generating enormous wealth. This permanent debt system solved one problem while creating a much larger one. It gave governments access to unlimited funding, but it also meant that citizens would pay interest on that debt forever through their taxes. A portion of every tax payment flows directly to whoever holds government bonds. Working people fund the government, and the government pays bondholders. It's a continuous wealth transfer from labor to capital, built into the foundation of modern economies. What we've just uncovered is only the first layer of this wealth extraction machine. The system Paterson created in England was just the beginning. Other financial innovators would take his template and expand it globally, making it impossible for any government to escape. They would create mechanisms that ensure debt can never be eliminated and that interest payments flow eternally upward to the institutions that control the system. In the next part, we'll reveal how this localized English innovation became a global empire of debt and how the architects of this expansion became the wealthiest families in world history, while entire nations became permanently trapped in cycles of borrowing and interest payments. The template was set, but it remained confined to England for decades. Then came a family that would transform Paterson's local innovation into a global empire of debt. The Rothschilds didn't just adopt the permanent debt model, they industrialized it, weaponized it, and made it inescapable for every major government in Europe. In the early 1800s, European governments had embraced borrowing as a way of life. They borrowed for wars, for infrastructure projects, for daily operating expenses. But the market was primitive and disorganized. Each loan required individual negotiation, interest rates fluctuated wildly, and only the wealthiest merchants had access to these deals. It was inefficient, unpredictable, and limited in scope. Nathan Rothschild changed everything by creating the world's first industrial-scale debt operation. The Rothschild family had started as money changers and traders in Frankfurt, but by 1800, 5 brothers had established banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, Naples. This network was unprecedented in its reach and coordination. Nathan, operating from London, was the strategic mastermind who understood that controlling government debt meant controlling governments themselves. During the Napoleonic Wars, he didn't just arrange loans for Britain, he revolutionized how sovereign debt functioned by creating what we now recognize as the secondary bond market. Instead of lending directly to governments, Nathan bought government bonds at discounted prices, then resold them to pension funds, insurance companies, and wealthy individuals at markup prices. He became the middleman in every transaction, collecting profits from the spread while creating a liquid market for government debt. Governments received immediate funding, Nathan collected his fees, and investors acquired tradable assets that paid regular interest. But Nathan's real innovation was making himself indispensable. He positioned the Rothschild network so that governments had no choice but to work through them if they wanted access to capital markets. The family controlled the distribution networks, set the pricing terms, and determined which governments could borrow and which couldn't. The famous story of Nathan learning about Napoleon's defeat at Waterloo before anyone else in London illustrates how this system worked. His courier network was faster than official government channels, giving him advance information about events that would move markets. He used this information advantage not just to trade profitably, but to demonstrate his power over the entire system. When Nathan sold British bonds before news of the battle arrived, other investors interpreted this as a signal that Britain was losing. Prices collapsed as panic selling ensued. After prices hit bottom, Nathan bought massive quantities at rock bottom prices. When official news of British victory arrived the next day, bond prices surged, generating enormous profits for the Rothschild network. This wasn't just successful speculation, it was a demonstration of market control that established the Rothschild model for the next century. Control the information flow, control the distribution network, control the market itself. By 1820, if a European government needed to borrow money, they went through the Rothschilds because the Rothschilds controlled access to the investors who had money to lend. Here's where the debt trap evolved from permanent to inescapable. Before the Rothschild network, when governments defaulted on their debts, specific creditors lost money and the system eventually reset. But Nathan made sovereign debt tradable across international borders, creating complex webs of ownership that made default catastrophic for the entire financial system. A British government bond might be owned by French investors who used it as collateral for loans from German banks, which provided funding for Austrian merchants. When debt became this interconnected, defaulting wasn't just refusing to pay one creditor. It meant triggering a cascade of failures across multiple countries and institutions. This interconnectedness was intentional. It made governments prisoners of their own debt because default would cause systemic collapse rather than localized losses. Countries became trapped in cycles of borrowing to pay interest on previous borrowing, with no escape route that wouldn't destroy the entire financial network. The Rothschild family wealth peaked in the mid-1800s when they were the richest family in the world, wealthier than any monarch. That wealth came from a single source: interest payments on sovereign debt. They didn't manufacture products, didn't build infrastructure, didn't create anything tangible. They lent money to governments and collected interest payments forever. The system Paterson created in 1694 had been industrialized by Nathan Rothschild by 1815, and every major government in Europe was caught in the web. But the debt trap was still limited to Europe and still dependent on gold-backed currencies. It would take another financial architect to make the system truly global and infinite in scope. By 1900, America was emerging as an economic powerhouse, but its financial system remained primitive compared to Europe. Banks operated independently without coordination, the money supply was tied to gold reserves, and there was no central mechanism for managing government debt or coordinating monetary policy. John Pierpont Morgan recognized this as both a vulnerability and an opportunity. As the most powerful banker in America, he understood that the country needed a more sophisticated financial system. But he also understood that whoever controlled that system would wield enormous power over the entire economy. The opportunity came during the financial panic of 1907, when stock prices crashed, banks failed, and the economy seized up. Morgan personally organized a bailout by gathering the major New York bankers in his library, locking the doors, and forcing them to pledge their own money to stabilize failing institutions. The strategy worked, the panic subsided, and Morgan became America's unofficial central banker. But Morgan was 70 years old and knew he couldn't personally manage future crises. He needed a permanent solution that would protect his banking empire while giving him lasting control over American finance. The answer was a central bank, but Americans had historically opposed such institutions as threats to democratic governance. Morgan's group solved this problem through brilliant political misdirection. In 1910, representatives from the most powerful banks held secret meetings on Jekyll Island, Georgia, spending 9 days designing the structure of what would become the Federal Reserve System. The meetings were conducted in secrecy because they knew public knowledge of bankers designing the national monetary system would trigger massive opposition. The plan they developed was a masterpiece of political manipulation. The Federal Reserve wouldn't be called a central bank, it would be called a reserve system. It wouldn't be one institution, it would be 12 regional banks. It wouldn't be controlled by Wall Street, it would be overseen by government appointees. But the structure ensured banker control at every level. The regional Federal Reserve banks were privately owned by member banks. Those banks elected the boards of the regional institutions, and the regional banks influenced the selection of the Federal Reserve Board. While the government appointed some members, the bankers controlled the system's operation. Most importantly, the power to create money and purchase government bonds was concentrated in the Federal Reserve Bank of New York, which was controlled by the largest Wall Street institutions, Morgan's banks. When the Federal Reserve Act passed Congress in December 1913, most representatives didn't understand what they were approving. Now you understand why your financial struggles aren't personal failures, they're systemic features. The debt trap that began in 1694 has evolved into a global machine that transforms your labor into wealth for financial institutions. Every tax payment, every interest charge, every government bond purchase feeds this system. The architects knew exactly what they were building, a permanent wealth extraction mechanism disguised as economic progress. Once you see the machine, you can never unsee it.